Hey everybody, Smart Silver Stacker here. Hope you're doing well. So we are headed towards a major economic crisis. Of that, I am convinced. See what you think as we go through some of the latest developments in this basket case economy. Starting off here with the chart of silver. So silver's had, a lot of ups and downs. Of course, always a volatile market. Clearly, though, we remain in an uptrend. And the fact that silver right now is retesting the $30 level, I think it's a great entry point. More importantly, let's move on to the chart of gold here, because this, I think, is really the more interesting chart at the moment. And the reason being that you can see on this chart here that we recently, just 2 trading sessions ago, broke out above record all-time highs. Now, since that time, we've seen the price of gold correct a bit after getting very close to 2,500, just kind of narrowly approaching that. Now, this blue line, that's the previous all-time intraday high for the price of gold prior to this breakout, right around $2,054. And you can see right now we are actually retesting that price. The price of gold right now actually exactly $2,454. That is right at the previous all-time high. Once you break through a resistance level like this, the idea is that it can turn into support, which, should we see gold bounce from this level and not correct any further, I think that's the case, probably headed to new higher highs for gold very soon, especially in light of what is occurring in the U.S. economy. Now, if you want to get your hands on some gold, premiums on physical gold right now remain very low. SD Bullion has got these 1-ounce South African gold Krugerrand coins available for $49.99 over spot. It's about a 2% markup over the spot price. So as these metals prices have risen, a lot of sellers have come into the market, a lot of retail investors unloading their physical bullion, and it's a good opportunity, I think, for us stackers to take the opposite side of that trade and get some low premium metal. Not financial advice, just telling you what I am considering doing with my fiat at the moment. Now, getting into the first bit of news here, the first signs of the devolving U.S. economy, jobless claims, new data released today. They've hit the highest level since last August. 243,000 initial jobless claims filed in the week ending July 13th. That is up from 222,000 the week before, and it is also above the expected level of jobless claims. So it's another sign of Bidenomics at work here, and also of the environment being inculcated by the elevated interest rates. Federal Reserve holding them at an elevated rate, refusing to cut until perhaps we get an economic crisis, although this weakness in the U.S. labor market is increasing the odds of a rate cut very soon. In fact, still nearly 100% chance being priced in of rate cuts coming in September, and it's no surprise why. I mean, you think about it, you've got a weak employment market. I mean, they can talk about all the jobs numbers they want. People picking up part-time jobs, bolstering the numbers of new jobs created. But when you start seeing unemployment rising and jobless claims on the rise, especially at a higher than expected tick, the other mandate, aside from maintaining stable prices at the Federal Reserve, is maintaining employment. So this is going to increase the odds of rate cuts. And more importantly, we have got record household debt, right? So you've got record household debt, a weakening jobs market, high interest rates on that consumer debt. You can see how this could lead to a real problem in the very near future as consumers begin to default on their debt in increasing numbers. And that is one thing we are seeing. We are seeing increased delinquencies on subprime debt, on credit card debt, on auto loans. And that's only going to get worse as the employment market worsens. Now, moving on to the CME FedWatch tool, you can see now, when we had the breakout for gold a couple days ago, the odds of a September rate cut were actually at 100%, according to this tool. Now, they've dropped to about 98.1%. So still we're getting rate cuts moving forward. But that does account also for part of, I think, the decline in the price of gold and silver over the past two sessions. A little bit of uneasiness about rate cuts, but it's a small difference, and I think a lot of it is just price, rather profit taking as well. Although, when you look at the price of silver, going back to the silver chart, we saw gold breaking out to record all-time highs on this day, and then silver absolutely getting smashed down the following down. Really no news. It does make you wonder about, manipulation in the paper markets, right? And there's probably some of that at play here as well, considering the degree of the sell-off following gold's breakout to record all-time highs. But again, this is a buying opportunity. If it is getting smashed down in the paper markets, great opportunity to get some physical at a discount. Now, the biggest bubble of all, the real reason for our economic calamity here is we've got the U.S. national debt on track to hit $35 trillion very soon. And this is the real cause of the economic calamity that's playing out here. It is the massive deficits, the onerous debt burden. You can see the U.S. federal budget deficit now exceeding $2 trillion. Interest on the debt over $1.1 trillion. This is another big reason the Federal Reserve is going to have to get into these markets and intervene in a big way, sending the price of gold and silver to new record all-time highs when they do that. I believe that that is what is around the corner. And, I think a lot of people have this idea that come November, everything is going to be solved in the U.S. economy. Now, it probably will be an improvement from Bidenomics. I mean, now Trump seems like the shoo-in for the next president. Of course, anything can happen between now and November, but it does seem that that's the way it's going. But listen, don't expect much to change. I mean, yeah, there's going to be rate cuts. There's going to be jobs created as a result of that. There's going to be easy money. The markets are going to be sent to record all-time highs. That is what I am forecasting here. But the dollar is going to be in serious jeopardy. And if you doubt that, look at who Trump is considering for the role of Secretary of Treasury. Jamie Dimon, head of mega bank JP Morgan. I mean, if you think the name of the game is going to change in November because of an election, well, got another thing coming. I mean, the same folks are going to be calling the shots. The name of the game is going to be devaluation of the dollar, probably at an even faster rate than we've witnessed, believe it or not, because what we're going to see is a lot of stimulus towards the economy, rate cuts at a time of already elevated inflation. We are going to see tax cuts, corporate tax cuts. Corporate tax rate's going to probably be cut to 15%. It's going to be good for stock markets. It's going to allow the creation of some jobs, but it also means there's going to be a lot of money sloshing around out there in the system. And again, I mean, the bankers are still going to be calling the shots here. Now, I want to draw your attention to the U.S. money supply and give you an idea of what is just getting started here. So this goes back to 2018, this chart. And you can see the money supply has been expanding steadily for years, had a huge spike up during the pandemic, and then consecutive rounds of QE drove it to record all-time highs around 21 point, let's see, where did it peak? Peaked in April of 2022, $21.72 trillion. The Fed then began quantitative tightening, selling off assets that it had purchased or allowing them to mature. The treasuries on its balance sheet, the almost or over $8 trillion worth of U.S. treasuries that were on the Fed balance sheet. They began selling those off in June. So we saw a small drawdown in the U.S. money supply, and it bottomed out in October of 2023, last year. Now, if we zoom the chart in to starting in October, you can see that since then, the money supply has been increasing, and since February of this year, it's really at a accelerated rate. So the Fed probably already intervening at some point, to some degree, in these markets. I believe they may be purchasing debt already to drive down yields. That is supporting the huge bubble in asset valuations that we are witnessing. And speaking of bubbles, I want to talk about that. I want to talk about the NASDAQ and tech stocks and what we saw happen over the past couple of days. So the NASDAQ, it's been putting in record high after record high after record high. The AI bubble, the chips, all this stuff, tremendous valuations for NVIDIA, AMD, you name it. ASML, the lithography company that makes the machinery to make these chips. Well, we saw what may be the beginning of the tech bubble popping. Just yesterday, saw a sharp trade down in all these tech stocks following an announcement from Joe Biden that he may use new powers to regulate the export of chip technology to China, the foreign direct product rule. Now, this is a rule that goes back to the 1950s. Under the FDPR rule, the U.S. can impose export controls on goods made by foreign companies if any U.S. technology is in the production or operation of the item. And U.S. technology, in one way or another, is integrated into this high-tech supply chain, whether it be that we design the chips or we have patents on some of the technology that goes into this. So companies like ASML, who makes the chip-making machines, Tokyo Electron, these companies that export chips to China, this is all part of a attempt to control the Chinese ability to get access to cutting-edge chip technology. So these industries took a big hit on this announcement. Also, we had Trump saying that Taiwan should pay the U.S. for its defense because it, quote, doesn't give us anything. So these two statements caused a fairly significant sell-off, which is ongoing in tech stocks and the NASDAQ. Now, that being said, I don't think that this trend is going to end. If we zoom out to the weekly chart in the NASDAQ, I mean, people will say this is just a huge bubble. And if you look at it on a regular chart, it does. But, one thing you got to do when you're looking at these charts, and I think I've probably been guilty of this in the past, is rather than looking at logarithmic charts, you look at, regular charts, which can make exponential price moves look a little more significant than they are. I mean, just take this chart and we'll switch it to logarithmic, which shows everything as percentage moves rather than dollar moves. And you can see that the run-up that we've had in tech stocks, I mean, it's been significant, but it's not like some huge blow-off top being hit when you look at it in a logarithmic form, right? It's just a steady progression higher, and that, I think, is likely to continue. Now, that's barring some major geopolitical event. I mean, when Trump says that, Taiwan needs to defend itself or pay for the U.S. for its defense, maybe this could potentially embolden China to make a move on Taiwan. Look, if that happens, until that happens, I think that this bubble is going to continue to build, at least for the foreseeable future, especially as the Fed is getting ready to cut rates. But if that happens, the level of economic calamity for the U.S. and the whole globe is going to be incredible. I mean, we're so deeply embedded with the Chinese economy and with these international supply chains. If Taiwan gets embargoed or if it gets invaded, you're going to see a huge economic pain. Where is all that money going to flow to, do you think? Well, it's going to go into safe havens, right? You don't have to worry about international supply chains when it comes to physical and gold and silver bullion. So I do think that such an event could drive a tremendous amount of interest in that. But there's another factor that is driving this gold bull market, and one of those is central bank purchases. We know right now retail investors, I mean, they're selling gold and silver. That's why premiums are so low right now. It's why it's a great opportunity for stackers. But central banks around the world are loading up on this stuff. China has taken a breather for the past 2 months, but I suspect that they might even be buying with their proxies as well. But officially, they've stopped. But this is one. It's Uganda. Now, this is not going to be like a major driver of the gold market by any means, but this is an interesting story because Uganda is announcing that they plan to purchase domestic gold to build their foreign exchange reserves. And again, they're not going to be making huge purchases. They're actually going to be buying from domestic producers. But Uganda does export some gold right now, and that means that that's not going to be available. We've also seen, we covered this a couple months ago, we had Ghana, the second largest bullion producer in Africa, telling the government they were going to acquire 20% of the local miners' production. So this is a trend in Africa. African nations, just like the rest of what you might call the global South or anti-U.S. hegemon, BRICS nations, whatever you want to refer to them as, they're getting increasingly interested in non-dollar assets, right? Physical, tangible wealth without counterparty risk. And notably, Uganda right now does not have any gold in its reserves. So this is a country now that is going to begin buying gold that doesn't have any gold right now. So this is a change for them. And I think you're going to see this continue to be an increasing trend around the world, that nations want to load up on physical gold. I mean, look, the U.S. debt alone is enough to make you question the role of the U.S. dollar as the world's reserve currency. And, barring any catastrophic effects of an expanding war or something like that, the U.S. dollar is going to be the world reserve currency for the foreseeable future. But its role as the reserve currency is diminishing, and the U.S. ability to pay this debt off in anything other than devalued paper dollars is highly suspect. And I think that nations around the world are getting the memo. Unfortunately, we've got retail investors in the U.S. seem to be divesting themselves of physical gold right at the same time that it would be wise to acquire some. And I understand, the economy is in the crapper. Jobless claims are rising. Inflation remains elevated regardless of what the official numbers tell you. And a lot of people are having a hard time making ends meet. So I get why they are selling gold and silver. I mean, silver's up, 28, 30% year to date. You might consider that a good time to sell. But when you look at the backdrop of what is occurring, these numbers, $30 silver, $2,500 gold, they're going to be small potatoes compared to what is coming when the Fed really begins printing. And that's going to be soon. There's even a possibility. Markets are only pricing it at 4.7% now. It's declined actually over the past couple days, that we could get a surprise rate cut at the end of July. If that does happen, expect gold and silver to explode, but almost certainly we're going to see rate cuts by September. And the reason is that the U.S. economy is crumbling before our eyes. I mean, you got exploding debts, exploding deficits, exploding interest payments, increased delinquencies, a consumer tapped out. More and more people are working part-time jobs just to make ends meet, and now unemployment is on the rise. So, the Fed, they're going to have to cut here sooner rather than later, or they're going to be met with an economic calamity. And then that means the degree of intervention is going to have to be that much greater. But let me know what you think in the comments down below about today's stories and about these developments. Are you stacking to get prepared? Are you selling your metal at these prices? Let me know what you think in the comments down below. Stay safe and happy stacking, everybody. Smart Silver